Hello everybody and welcome. This is Tushar Chande. A big week in the markets ending 3rd of May 2024. So let's do a little technical analysis on the S&P 500 Index. A gentle reminder, past performance is not necessarily indicative of future results and there's risk of loss in trading. There was a lot of groupthink in the market expecting the next steps of interest rates to be higher. But at the end of the FOMC meeting on Wednesday, Chairman Powell more or less ruled out that the next step in the evolution of rates would be a rate increase. And then on Friday, job creation was weaker than expected. Tech earnings were better than expected. And over the previous weekend, there was a lowering of tensions in the Middle East. So all in all, a good week in the markets. So here we summarize the performance of various ETFs versus the S&P 500 index. Observe that the very broad Russell 2000 was the strongest, so there was a lot of market breadth, and bonds rallied. So LQD and HYG, that is the corporate bonds, were doing well because there's sort of a risk-on switch in the bond market. We continue with the TC Blast indicator. This is where we were on 427. The market pulled back a bit and then rallied into overhead resistance, essentially validating the entry signal of buying strength after weakness. This is the arch indicator, the adaptive regression channel indicator with 35 days and a 5-day delay, so it ends here instead of all the way there. We've drawn bands of plus or minus 1 sigma or plus or minus 2.5 sigma, which are the default values for computing bands. This is 427. We hit resistance near the top of the plus 1 sigma band, pulled back, and then rallied again to overhead resistance that we had identified. And of course, we will have resistance here from this downtrend line. This is the TC arch indicator again with 35 days, 5 days delay, and a plus or minus 1.5 sigma bands. So we've widened the inner bands because the 1.5 sigma band has been offering resistance. We've just pushed above this resistance, so now we have to follow through, and then we still have overhead resistance here. Here we have the FAMA indicator, the fully automatic moving average. I had said that we'd have to push above the value here. This is 427. We pushed above resistance, came back into support near the lower band, and now we pushed up again. So this is a bullish configuration showing at least a short-term uptrend into this overhead resistance. This is daily data for the VIX index of market fear factor, if you wish. We have the arch indicator with 35-day look back, 5-day delay, and plus or minus 1 sigma and plus or minus 2.5 sigma bands. Observe we went above the 2.5 sigma band, strong overhead resistance, came right back down till we are slightly below the lower 2.5 band. So now we have to see whether market will allow it VIX to maybe rebound a little bit and then continue lower. This is a much longer term look at the VIX index. We've drawn an upper resistance band and a lower support band. We came right into the resistance area and then back down very rapidly. Anything below say 16 means the market wants to trend. So now we're back into a region where the volatility is low, so which means that the market is likely to trend. Here we have daily data for IEF, which is the iShares 7 to 10 year Treasury bond ETF. Gives you a sense about what's happening to bond yields. When IEF is rising, bond yields are falling. When IEF is falling, bond yields are rising. So you could say with the traditional technical analysis, it retraced about 62% or a little bit more of this up leg. It's locked in a firm downtrend. You'd have to overcome fairly significant resistance, say the 94 level, and maybe going up to about 96 for the uptrend to resume, which means that bonds are not yet supportive of a huge move in stocks at this moment. Continuing with the IEF, I've marked resistance here at 93.5, let's say. We have more resistance at 94, and the long-term momentum persistence is still to the downside, so we'd have to get a crossover between the green line and the red line to confirm a new uptrend in bonds, which would help support stocks in the longer run. So in summary, all the tools I've used are at TrendSpider.com. We need a sustained improvement in inflation data to come, i.e. the CPI and the PCE, and the unemployment data to gradually decelerate so that the bonds can be more supportive of stocks. If you want to look at the PCE data drill down to better understand inflation conditions, you can watch my video here, and I hope you like and subscribe. Thank you for listening.